Hello, everyone. Welcome back to another edition of Signal or Noise. This is episode 35. Charlie Bilello here with me, as always, Peter Mallouk. Peter, I want to run through the docket here. A lot of interesting things going on in markets and the economy. Number one, holding the supply chain hostage. We have to talk about the port strike and the potential impact there in terms of GDP, in terms of inflation. Number two, front-running the Fed. So the Fed did that historic 50 basis point cut. We'll talk about that, the impact that's going to have potentially. But the bond market has gone crazy in anticipation of that. So we'll discuss that. Number three, a barrage of stimulus that coming out of China. Huge, epic move in Chinese stocks over the last 10 days. We'll discuss what that could mean for emerging markets going forward. Number four, die with zero. Seems like a crazy concept, but there's a book that you recommend. Based on that, we're going to discuss that and also my favorite book of the year so far. And we'll end, as we always do, with Signal or Noise. You've probably seen this headline, Peter. It's becoming more frequent. Buy these 5 stocks. If Trump wins, if Harris wins, the assumption is that you can pick stocks that neatly fit into a presidential narrative and you're going to do well capitalizing on that theme. And we'll tell you whether that's a signal or noise for investors. Okay, let's start out holding the supply chain hostage. What am I talking about here? The huge port strike that's going on, ports from Maine to Texas, so really East Coast and more. And the head of the International Longshoremen's Association, Harold Daggett, interesting character here. He's saying a lot. I'm going to play a video for you in a second. In terms of what he's been talking about, but he's saying essentially nothing's going to move without us. And they've rejected, Peter, a 50% wage increase over 6 years. They're saying that's not enough. What do they want? They want 77% increase over the next 6 years, which would be about 10% a year. Obviously an enormous ask, but I want to get your raw reaction to this video. This is the head of the Longshoremen's Association that's negotiating this deal. Let me try to play this for you now.
These people today don't know what a strike is.
Right.
When my men hit the streets from Maine to Texas, every single port will lock down. You know what's going to happen? I'll tell you. First week, be all over the news every night, boom, boom. Second week, guys who sell cars can't sell cars because the cars ain't coming in off the ships. They get laid off. Third week, malls start closing down. They can't get the goods from China. They can't sell clothes. They can't do this. Everything in the United States comes on a ship. They go out of business. Construction workers get laid off because the materials aren't coming in. The steel's not coming in. The lumber's not coming in. They lose their job. Everybody's hating the longshoremen now because now they realize how important our jobs are. Now I have the president screaming at me, I'm putting a Taft-Hartley on you. Go ahead. Taft-Hartley means I have to go back to work for 90 days. That's a cooling off period. Do you think when I go back for 90 days, those men are going to go to work on that pier? It's going to cost the company's money to pay their salaries. Well, they went from 30 moves an hour maybe to 8. They're going to be like this. Who's going to win here in the long run? You're better off sitting down and let's get a contract and let's move on with this world. And in today's world, I'll cripple you. I will cripple you. And you have no idea what that means. Nobody does.
Okay.
Like watching a character from The Sopranos.
Yeah, essentially.
Right.
What's your raw reaction? Now, one other thing I want to add, I didn't mention it. And part of their demands also, Peter, is not just pay increases, but no automation. So you cannot automate any part of their job as part of the deal, which is kind of incredible, obviously, because everything's being automated and people are pointing to ports out of China, which are almost completely automated at this point. All right. What's your gut reaction?
Well, I think, first of all, I think he's generally right about the short run, that we really rely on shipping. I think the timeline might be a little tight. You know, places aren't going to close in one week or 2 weeks, but it would be extremely disruptive, especially if it went on over 30 days. And so in many ways, they can fight for a lot of what they want. But the real issue here isn't compensation. It's the automation. and the automation is coming. It just is. And you can see it, to your point, Charlie, in the ports in China. And we know that that's what it's going to look like. If it's not 5 years from now, definitely 10 years from now. And so, like, it's a short-term issue. It's what are you going to pay them over the short run? Because in the long run, it's one of many, 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 many jobs that will be automated, and big parts of our jobs will be automated too. That's just the reality of the future. Just like the internet had a big impact on everything as well.
Yeah. To me, it's just kind of crazy that really our entire economy could be held hostage by this small group here. And who are they negotiating with? They're negotiating with this group of companies. Some of them are international, some of them are US, some of them are part of the government. It's this huge consortium of different interests that go on, into it, but they seem to have all the cards. And unless someone changes that system, and I don't think it's a coincidence now we're a month away from the election that they're doing this and essentially saying, well, we'll see what happens if you don't do it. And are they going to threaten to replace these workers? I haven't heard anything like that. It's just a question of how much I think they're going to get, because no one wants to run that risk before the election of the economy going south, of inflation going up significantly. We've finally solved the supply chain problems from COVID, and now we potentially have another one. And there's stories already, Peter, if you can believe it, you probably can. I have Costco in New York and New Jersey selling out of paper goods, paper towels, toilet papers. It's like a bad rerun of what we went through just a few years ago.
Yeah, seeing the pictures of some of the stores is it definitely brings back memories, and is not surprising if this really happened. But I agree. I think that they're going to get a lot of what they want, simply because the alternative is so overwhelmingly negative, especially this within 30 days of an election.
Yeah, and I don't begrudge anyone getting what they're worth, 100%. If these workers are worth 70%, 7% more, 100%. But it doesn't seem to be based on supply and demand here whatsoever. And I'm showing you here the breakdown in terms of compensation. The median worker, longshore workers, making between 150 and 200,000, and an additional 100,000 in benefits on top of that. They have pensions, they have the best healthcare, they have all these other benefits as well. And this is as of 2019, 2020, Peter. So you can imagine, obviously, there's certainly been an increase on top of that as well. And how does that compare to the average, let's say, crane operator in the US, 68,000? If we look at Boeing machinists, 75,000. So not even in the same ballpark, it seems like. And this is just crazy stats here. And this is in 2020. So remember, likely much higher than this. More than half of these dock workers earned more than 150,000, about 1 in 5 over 250,000. So to me, certainly not based on supply and demand. And if you're going to say that we're not going to do automation, we're not going to, like, how, that's not sustainable. So it's similar to the GM and situation we had, GM, Ford, the auto workers strike last year. If you pay people much more than they're actually worth over time, what's going to happen is you're going to cut labor. It's going to, automation is going to be sped up by that process. So I think to start out here in terms of negotiation, you absolutely can agree to that lack of automation, especially in this type of area. It's going to be a cost that we all bear, by the way, right? And so if you say, well, who cares? Let's pay this extra amount. Well, we're going to all feel it in terms of the price we pay as consumers.
Yeah, just all goes through the cost of goods sold. Yeah, it'll get passed on to the consumer. But the long run is destiny, right? We know how this is going to be 5 or 10 years from now, because it already exists in parts of the world. And I think this is a short-term deal with, extremely high stakes, short-term deal. But I mean, there's no incentive for the government to play hardball here.
Right. So what they could do, and he mentioned it in there, he said, yeah, they could invoke this Taft-Hartley Act where they go in and essentially force these workers back for 90 days. It's a cooling off period, and hopefully an agreement will be reached. So far, the Biden administration says, no, we're not going to do that. We're going to stay out of it. We'll see if they change their tune based on what happens in the next few weeks, because it's going to cost money. JP Morgan's estimating 4.5 billion a day. They're saying it could shave a 0.5% off of GDP. That's assuming, I guess, it only lasts a little bit of time. So this could have a significant impact. And to me, Peter, the biggest impact will likely be on this picture here, which is in terms of inflation. If we're going to cut off all of these goods, are going to be shortages. We know what that's going to do in terms of prices. You and I talked about price gouging, right? And the idea that these supermarkets were price gouging. We kind of debunked that, I think, pretty well. But isn't this price gouging essentially by this union that's controlling the port, which is essentially saying you have to pay us whatever we want, or we're going to cripple you, as he said?
Yeah, I know. You look at when the administration was talking about the price gouging at grocery stores, and grocery stores have some of the thinnest margins that exist in any business in the United States. And the reality was there's no price gouging. It's the cost of food has gone up because of inflation, because of government policy under Democrats and Republicans.
Yep.
And that's what created the inflation that then just, even with a very tight margin, you're going to have higher profits, whether you see that at the grocery store or the pump. But there you have a free market, you have competition that's keeping the prices tight. To your point here, what we have is no competition, right? Like if there's a strike, we don't just have a bunch of people that can walk in and take over this job the next day. And so that's where you can wind up using leverage to actually create price gouging. And that's what you don't just see it here, you see it in all kinds of professions where a group of people can come together, and when the timing is sensitive to the other side, can create an artificial outcome.
Yeah, it seems to me this is too important. I understand the right to be in a union, but in this area here, Peter, it seems way too important to allow this union to control everything in terms of
Yeah.
the negotiation power of the U.S. economy. So something has to be done. It's essentially a monopoly, I would say, and monopolies we know in many areas are not good. And this is, I think, front and center here. Now, obviously, the union vote is very important. We're a month away from the election. You don't want to jeopardize that either side, right? So they're going to be very careful trying to handle that. But ultimately, for the good of the American people going forward, regardless of what they agree to this time, they have to make sure going forward that this balance of power is not so one-sided, and that we're not put in this position again in the future, would be my view. So we'll see what happens here. Hopefully, obviously, there's a resolution. We definitely don't want to see inflation spiking again and goods shortages and the rest of it. But I think it's a good lesson in terms of free markets. You don't have a free market. You have all this power vested in a few individuals. This guy who's speaking here, Daggett, he's coming across as a blue collar worker. He's talking about, but the reports that have come out about him show that he's making close to $1 million. His son is making like $700,000-$800,000, and it's all of these jobs are passed down, and there's a lot of nepotism. And it's certainly not a free market in terms of you're getting paid what you're worth, which everyone should be 100% in favor of.
Right.
What we don't want is this balance of power shifted where it's just one group has all of the power and the rest of the American people really have no say. So hopefully Congress, the Senate, figures something out going forward and bust what I would call this monopoly in terms of the ports. Okay, let's move on to number 2, front running the Fed. And Peter, big 50 basis point cut there in September. A little bit surprising to me. I thought a week in they were going to go with 25, and then all of a sudden the odds shifted. Whereas a day before, I don't know if the Fed was influencing it or they leaked it. A day before, the market was about 65%, 50 basis point cut, and that's exactly what they did. Do you think that a 50 basis point cut was the right move? Too much? Doesn't matter? Were you a little bit surprised, as I was, that they went that big to start out with, given that the economy still seems to be doing okay?
I thought it was a little bit interesting that like a month prior, Biden said he expected a big rate cut in September, and so he wasn't surprised. I don't know. I tend to when we get this close to the Fed meeting, where when you're a week out, the market's pretty accurate there. It had it, like to your point, as a toss up, so wasn't surprised either way. It's hard to tell. I mean, it looks like they clearly see weakness ahead, and I think anecdotally we see that from a lot of our clients that operate businesses that they're seeing that they feel good, but they're seeing slowdowns that are now significant, right? But they still feel good. Their businesses are still healthy, but the bloom is definitely off the post-COVID rose, right? Right. We've definitely come off the craziness coming out of COVID, and we've started to settle. I think their timing might have actually been right. They've been wrong about everything. The response from COVID to now has been an absolute complete disaster that has huge repercussions. for the United States with the national debt and everything else that we're dealing with. But I think here they were probably getting in front of things, and I think maybe the proof of that is the market and still expects rate cuts, and they have indicated further rate cuts, which means that was just one step in a long road to go.
And what do you think the biggest impact of those cuts are going to be?
Well, I think one of the big things is looking at what's happening with housing. I mean, we had nobody selling any houses for a long time, a huge lack of supply. This is causing a big problem, especially for middle America. These people are voters, and obviously, they make the whole economy go, right? We can't have this two economies that we have right now, where wealthy people are just fine and everybody else is having a hard time. And if you want to make the economy accessible to everybody, you have to make it reasonable for someone to buy a new house and reasonable for somebody to carry their debts. And I think that this we got a long way to go to really get the housing market back where it needs to be, but it's a good step. What do you think?
It will be interesting. Yeah, housing was so crazy the last few years in terms of just didn't do anything like it did historically in terms of the collapse in supply. And people's assumed that higher interest rates would cause prices to come down. That didn't end up happening because supply went down so much more. So it will be really fascinating to see if we see the reverse here, where more people start listing with mortgage rates going down. So you get a double boost for the
Right.
person who hasn't bought that home, where they have lower mortgage rates and perhaps lower housing prices. We're a long way away from that, but if we look at housing supply just in the last 6 months, Peter, trending upward every single month. So
Yes.
a good sign there. And so speaking of front running, which it seems like the housing market is moving ahead of the rate cuts, it seems like the bond market has been doing that in spades here. 1 year return for the bond market. This is kind of incredible here, given where we were a year ago in terms of sentiment. 12% return for the Bloomberg aggregate bond market in the US. And we looking here at the last 5 months, 8% return for the US bond market. It's the biggest 5 month gain since 1995 in bonds. So big change. I'm sure you're hearing it from clients, or maybe you aren't hearing it this time, which is a big change for the last few years, where all you hear about is, why do I have these bonds in my portfolio?
Right.
Because they're going down. And very quickly, we talk about here, markets are not linear. Once again, we're getting this just spike higher, where essentially 2 years worth of returns for bonds in 5 months.
Yeah, I mean, the bond market is telling us that the Fed's got a ways to go because they didn't just price in the drop. They're pricing in future drops. They expect people who want to go buy brand new bonds to get lower yields, making the old bonds more valuable. So the bond market definitely, which I think is smarter than the stock market. There's more trading in the bond market in the first hour of a day than the stock market all day. Most people don't know that. We just don't talk about it because bonds are super boring. But the bond market is telling us the economy is likely getting weaker. The Fed's going to try to prop it up by lowering rates. It also, is making up for those lost years, couple years of negative returns. You don't see that very often with bonds. The other thing you don't see very often is stocks and bonds being so correlated. We saw bonds have a negative year while stocks had a negative year, and now you see a huge bond rally with a huge stock market rally. This is a very rare occasion, and that's when both are driven substantially by rate movements. And so it's just a very rare environment that we're in. I don't think it's the new normal, but a pretty interesting thing to see over the last few years.
Right. And in terms of expectations for bond investors, if you're a long term bond investor, you're holding for 7 years, just forget about the short term noise. Don't expect, obviously, that 8% return. What you should be expecting, 10 years around 3.8%, should be expecting around 4% per year for bonds. Maybe it goes higher than that if yields continue to go down, and if yields go back up, maybe it's lower than that. But over the next 7 years, that's should be kind of your expectation. And we talk about, Peter, why should you own some bonds? It's really for liquidity needs, and also so that you have money to rebalance when the stock market goes down. So as you said, stocks are going up, bonds are going, everything's going up lately, but there will be a time when then that's not the case. And if we look at bonds historically, there's no better predictor than that beginning interest rates. It's not like the stock market. It's very hard to predict what the stock market's going to do over any 7 year period. With bonds, you end up getting very close to that starting yield.
That's right. Bonds are math.
There you go. Okay,
And
number
that's
three.
why they're boring. Right? If you
Yes. A barrage of stimulus here, Peter. You and I talked about this early in the year, where China was essentially deemed uninvestable. worst performing market. We're talking about January and February. China stock market's in free fall. There were a million different headlines, and there's a lot of good reasons behind it. We're talking about the economy slowing down, the real estate market there, a lot of different demographic issues the country had. And then all of a sudden, a few weeks ago, you have this stimulus announcement from the central bank there. They're lending for so people can buy into the stock market. They're offering relief for home buyers. They're likely going to cut their central bank rate. They've already lowered their repo rate, and they're lending just in general $142 billion. And this comes on top of earlier this year. I don't know exactly. It's hard to obviously with China, you have to be careful in terms of what to believe or not to believe. But early this year, there were all those reports that China was going to essentially start buying stocks themselves, 278 billion. I don't know if that actually happened or not, but it's kind of interesting to me that the Chinese stock market was doing not so well until a few weeks ago. And perhaps they bought all of this stock, the government, and said, it's not going up. We need to do something about it. So they do this big central bank announcement, stimulus announcement. And look what's happened in the last 10 trading days. This is kind of remarkable, obviously, for a market that's this big. 36% increase, Peter, for the Chinese large cap ETF over the last 10 trading days. Only October, November 2008 was bigger during, of course, the financial crisis, when really it was just rebounding from a sharp sell-off. What do you make of China, stimulus, and this kind of crazy move in terms of stock market performance?
A couple observations. I mean, one, yeah, it's a big market, but for perspective, the entire market cap of the entire stock exchange in China is less than the Apple market cap or less than the Microsoft market cap. So we're talking about a big market, but still nothing compared to the United States. I think second, you can't trust the Chinese market. I mean, they don't follow the accounting principles. There are so many well-documented games that are played with companies that go public in China and the government involvement in those companies. And then third, you have a lot of government interference. Now, that part happens in the United States all the time, too. You know, when we had our crisis, the United States came in and manipulated the market and propped up the market. And I think that's what China's probably doing here, because it's in their interest on every level, or at a minimum signaling that they would enough to attract investment.
Yeah. So I guess the question for investors is, well, what's going to happen going forward? If we look back in history, it's not really a big sample size here, obviously, for
Right.
this type of gain. But as we know, the Chinese stock market has not done very well. So if you would have bought into it in spikes in 2007, not so good. 2022, we had a big spike higher, not so good. The 2008, 2009, the market was higher a few years later, but nowhere near the US market. So history isn't very good in terms of buying into the stock market in China after this type of events, but who knows? Every time is different. Perhaps this time will be different as well. We know that they finally seem to be motivated to get people more interested in buying stocks there, which is, if you look at the ownership of stocks in China versus the US, far, far lower there. People are more invested in real estate and just keeping their money in cash. So very skeptical, but it's fascinating to me to hear, Peter, the last few days, famous investors in the US piling on this, saying, you got to get in. This is the time to get in. I did crickets literally a month ago, crickets in terms of buying into China before this 36% move, which is just, I guess, how sentiment works. People love to buy things after they've moved higher, not before.
Yeah, 100%. And this is not a market. I consider this market a roulette wheel. I mean, if you've got some incidental exposure through emerging markets or international, great. That maybe a dice diversifier for a little tiny piece, but this is not a market for
not going to be a core holding for you.
No, not a core holding.
Yeah, I completely agree. Regardless of what happens, now it's too binary of a situation. As you said, trust is the most important thing, and if you can't trust the fundamentals, underlying fundamentals, then at the end of the day, what do you have? But it is kind of incredible here to see it at the top of this list of
Yeah.
country ETF returns, which I only like to point this out, Peter, because it's almost impossible to predict each and every year what's going to be at the top of this list. It's almost always a shock. So China probably should have been the bet coming into this year, just considering the sentiment and everything was bad, and there's no reason to expect it to be at number one. And of course, it's now number one in terms of the ETF.
Yeah.
Interesting, U.S. stock market once again, Peter, outperforming international. How many years in a row have we been talking about this? But I want to talk about emerging markets more broadly. So China is the biggest holding in the MSCI index and other emerging market index still, but its importance has gone way down. India, I think, almost caught it in
Yeah.
a couple of these indices before this rally back. But this is showing you this year, emerging markets to US, we haven't even got back to even. So we're talking about on a year-to-date basis, emerging markets still underperforming after this historic move. And this is what it looks like if we pull back here and zoom out over the last 13 years. The underperformance has just been stunning, and you can't even see that rally in this chart. It's not even noticeable. We hit just a few weeks ago the lowest relative strength of emerging markets to the S&P since March 1999, close to all-time lows. And in terms of cycles here, you can see emerging market outperformance, then U.S. outperformance in the mid to late 90s, and EM outperforms through 2010. And since then, it's been all U.S. So I guess the question would be, if this is a turnaround for China, not just speculatively, not just in terms of boosting the stock market, but in terms of the real economy there, in terms of growth rates, in terms of profits for companies, could we be at a turning point in terms of emerging markets relative to the U.S. finally here?
There is going to be a day when emerging markets makes up the difference. It's going to go up probably 150% in a couple of years. I mean, this is the kind of thing that moves like a small cap index. When it decides it's going to turn, it will turn in a fashion that is going to be jaw dropping. I mean, just completely stunning. I think India is the future. It's a big part of this index. China, if they can figure out their population problem, you got over 1 billion people and a clear path to 500 billion with what's going on now. But if they can somehow solve that, they're going to be a superpower economically, not just the way we view them today. And I think what they have that we don't have is they reinvest in themselves, right? They're not like constantly, spending money on all this overseas, military stuff that the United States does. They're investing in themselves. And so they are a country that's becoming wealthier, and they're reinvesting in their own country and their own people. If they can solve the population part, I think this is going to outperform over the next 20 years. It's just going to be a very, very volatile ride.
Yeah, and diversification. But EM is about 10% of global market cap. So it's a small part of your portfolio, likely. But we've seen these cycles go both directions. As you said, it wouldn't be surprising to see this thing spike higher, but it's going to take more than, I think, just some stimulus coming out of China. It's going to take real profit increases, right? So the valuation gap, everyone knows, right? EM is very cheap, US very expensive. But the narrative has been US expensive for a reason, and EM is cheap for a reason. And so therefore that should persist going forward. Will be interesting to see if and when that narrative changes, where it says, oh, EM is going to have a big profit boost and valuations don't reflect that, or US is going to have a downturn in terms of earnings and its valuation is too high. We haven't yet seen, I think, a change in that particular narrative, but certainly would not surprise me if we're talking a year from now to say perhaps this is starting to move in the opposite direction, just because who's really positioned for this at this point, Peter, right? Who's stuck with emerging markets for 13 years? I can't think of very many people
I
that
think
would still be
asset
involved.
allocators for sure, like I have. But if you're doing it as your only position, you're out of your mind to start that way.
Yes.
If you're doing it as part of your portfolio, like you're doing with small cap and everything else, you'll be
Correct.
rewarded.
Right. If you're just buying the global market index, that's fine. Then you're rebalancing and you're constantly adding to it. Then eventually, assuming emerging markets aren't going away, then eventually it's going to pay off. And these cycles seem to go back and forth, and nothing outperforms forever, which is why, of course, you want to be diversified. Okay. If you're thinking about your own portfolio, where EM should fit in, asset allocation in general, reach out to us today. creativeplanning.com/Charlie. Get this free wealth path analysis. We're going to go through your portfolio. We're going to make sure you're on the right path to retirement, give you some proactive tax strategies. Creative Planning, we're in all 50 states, so we likely have a location right near you. Over 300 billion in assets under management and advisement, and we're here to help. So reach out today. creativeplanning.com/Charlie. Okay, number 4 here, Peter. Die with Zero. This was a book. I'm going to let you take it away here, by Bill Perkins. Tell me why you recommend this book, and the concepts, important concepts that people can take away from
All
it.
right. Well, I enjoyed this book. It's a quick read, and I know it's a little bit controversial in that, that I would not use him for money advice, right? But what I took away, his thesis is basically like, hey, you only live once, enjoy your life. Experiences are more memorable and more satisfying than things. So go ahead and live your best life. And here are some quotes. Unlike material possessions, which seem exciting at the beginning, but then often depreciate quickly, experiences actually gain in value over time. They pay what I call a memory dividend. And then he also says later in the book, rather than just focusing on saving up for a big pot full of money that you will most likely not be able to spend in your lifetime, live your life to the fullest now. Chase memorable life experiences, give money to your kids when they can best use it, donate money to charity while you're still alive. That's the way to live life. This is a lot of what we talk about all the time. And I think I have a chapter in every book I've ever written that basically says something like this near the end. But I think the difference is, he's basically saying, like, just drop everything, and go do everything right
Yeah.
now. And I think if a reasonable person would step back and go, there is some natural positive tension here. Like, if you've got kids, you want your kids to be in school. Part of the experience is just living a normal life with your family. And then you go to work and you have vacations, and then sometimes you do other things. But I do agree with some things he says, which is, one, experiences are a really big deal. It's not just what he says. Like, when we look at the studies around, say, a vacation, the thing people get the most out of it is looking forward to the vacation. Then second, the vacation itself, and then third, the memories of the vacation. So the experience is super powerful in that, even maybe more powerful than he outlines. But the big takeaway for me in the book, and he doesn't even talk about this as being a big part of his book, but I thought it was just really brilliant, is he talks about how certain experiences expire. Like, if you're a college student and you're going to hike through Europe, this idea that you shouldn't go and you should save money for retirement or for something else is crazy, because you know what? When you're 50 or 60 or 70, you are not going to have the same experience backpacking through Europe and staying in hostels and all this kind of thing that you can only do at that time. So I like the idea of experiences over things. I like the idea of living a full life. I don't like the idea of hoarding everything and then giving it to your kids or charity when you're gone. Enjoy, it's better to give with a warm hand than a cold one. Enjoy that while you're living. But I really love the idea of, there are certain opportunities, once they pass, they're gone forever. And so really look out for those. So you can ignore the general money advice in the book. That the takeaway is what I just outlined.
Yeah, I think a lot. I just read. I haven't read the book, but I read some of the reviews there, and people were criticizing him for a few things. But I think a big one was borrowing money to go on those experiences when and also like spending down your retirement before you get to the retirement,
Right.
which I guess I think he's saying it more that you're not going to be healthy enough to be able to use it at that point. You're going to, a lot of people spend a lot less than they think during retirement. So I don't know if it's true, but people were saying, he's saying, start to spend it in your 40s and 50s before you get to retirement. Would you agree to that? I guess it all depends on the exact situation, right?
Right. Of course, it depends, but if you're an adult, you got some common sense, you read the book, you can ignore some of the
Yeah.
crazy advice, the money advice, and focus on this idea of experiences for sure.
Yeah, and Dying with Zero, I think obviously that's an extreme title,
Right.
good, very good title. It gets a lot of attention, but I don't think a lot of people actually want to die with zero. You have to time that
Right.
perfectly, and I don't think he's giving. There is a benefit to having that peace of mind of having that money sitting there, even though he's probably right. Most people aren't going to use it if they have this huge retirement balance that's built up, but they get a comfort. They could sleep at night. There is some value to that, isn't there, Peter?
100%. Obviously, having a cushion gives you peace of mind. Nothing's more valuable than that.
Okay, my book of the year so far, The World Played Chess. It's a novel. It goes back and forth about experience in Vietnam and during the war there. 18-year-old sent off to war, and then it goes back and forth between present day and also when when this individual comes back from the war, and just an incredible novel, Peter, and just makes you really appreciate the fact that we're not in a war where people are being sent there without their consent, and my kids don't have to worry about it. I haven't had to worry about it. I think we take it for granted a lot, and just the horrible things that obviously went on during that war, during every war, and it's front and center when you actually read about it. He did a lot of research looking at people's real accounts of that time, and it's heartbreaking, obviously, and just a beautiful novel. Again, goes back and forth between the time periods, but really recommend it to anyone who doesn't know much about Vietnam, or doesn't know much about war experiences, and just the difficulties of coming back from that.
And are they going to make this? You've been on a streak of books that are going to be movies. Is this one of those?
I could definitely see
Yeah.
this being moved. I would definitely see this as a movie, 100%. So we'll see. Yes, but you're right. A lot of the books I recommended do end up being movies. So we'll see. Okay, Peter. Let's end with Signal or Noise here. I want to rewind to last November. You and I were talking about this headline out of Barron's. Pretty irresponsible headline saying presidential election years are bad for stocks. Why is it irresponsible? Because the data shows the exact opposite. Presidential election years actually a little bit better than average. And this year, much better than average. 43 all-time highs already through the first 9 months of the year. And it is now the best start to a presidential year in history. Of course, we still have a few months to go. This could change, but 20.8% return for the S&P 500. We haven't seen a presidential election year like this. So, of course, we're not getting questions now about, should I get out because there's an election coming. What we are getting questions about from clients is, should I be positioning for a Trump win or a Harris win? And there's headlines all the time, Peter, you hear what to expect from the stock market if Harris wins, 5 stocks to buy if Harris wins, or 7 stocks if Trump wins bigly, or 5 stocks. So there's all of these different ways that the media and just investors in general being persuaded by the media to take a side and say that this is going to do well or that's going to do well if one of these candidates win. Is there any credence to that? Let's say you knew that Harris was going to win or Trump was going to win. We're a month away from the election. Let's say you knew with certainty, you had a crystal ball. Do you think you could actually pick the stocks that would do well during that presidency, or sectors that would do well during that presidency with that knowledge?
I think this is so much noise with capital letters that even if I knew with certainty who was going to win, I would not bet on any stocks or even industries based on the election. It's just too dynamic. The last couple elections are proof of that.
Yeah, I'm going to walk you through the data here on that. This is the most fascinating, I think, is the clean energy, traditional energy, and kind of the narratives around that, right? So we have this narrative, obviously, Obama's good for clean energy, Trump is bad for clean energy, and vice versa in terms of traditional. Look at the returns here. Obama's first term, clean energy ETF down 54%. Trump's first term, clean energy up 306%. Traditional energy, 84% gain during Obama's first term. Trump's first term, clean energy, traditional energy declines 29%. And then you look at these other sectors. I just did a quick Google search in terms of what sectors do well during Trump or Harris, and these are the ones that came up. And sometimes they argued it would be good for both or bad for both. No rhyme or reason, but as you can see here with these other sectors, it's 100% noise, whether it's defense, which seems to be good under any president, probably for good reason. Those would seem to be the companies that continue to get more and more money, unfortunately. But infrastructure, industrials, healthcare, banks, tech. There was a narrative right before the election when Trump was elected, where essentially I saw like 20 different headlines saying Trump is going to be bad for tech. 179% gain for XLK during his presidency. Not that Biden has been bad, it's up 77%, but this notion that someone's going to be good or bad, and you can predict that in advance, 100% noise, as you said. And just look at the returns here during each of these terms. This is the more remarkable thing, I think. If you're just diversified, you buy the S&P 500. Obama's first term, you make 100%. Second term, 66%. Trump's first term, 83%. Biden so far 58% return. You don't have to pick sectors. You don't have to pick individual stocks. If you just bought the index during these presidencies, you would do pretty well. And here's the crazy thing. I know you always talk about, you have a few examples of investors that talk to you after Obama won, and after Trump won. And isn't this kind of remarkable, Peter, that if we look at the last 4 years after a president has been inaugurated, 2009, 2013, 2017, 2021, these are the returns during those years: 26.5% in 09, 32.4% in 2013, 21.8% in 2017, and 28.7% in 2021. So if you got out of the market because you hated Obama or you hated Trump, man, did you get it wrong. And immediately, almost, the return goes in the opposite direction.
Yeah, I mean, I remember where I was with conversations around President Obama and President Trump being elected, and people wanting to leave the market, and just how damaging it was to their portfolios that they exited. Just, for the millionth time, the market is not blue or red; it is green. It only cares about corporate profits. Companies are going to find a way to make money over the long run. Every now and then, you'll have a president where the market's down, and it's not because of who the president is. It's because of some external event, like President Bush with the 0809 crisis, right? So just try. I know this is hard in America. Try to see past the political noise, and you're less likely to make a fatal mistake.
So, yeah, great words of wisdom there. But I want to preempt the questions I'm going to get in terms of 2025, which people are going to, well, we're going to see another 20+% year. Possible. But if you notice, before the 2009 year, 2007, 2008, not so good. 2011, 2012, a little bit below average. 2015, 2016, a little bit below average. Actually, 2021 came after 2 strong years, but we have 2 20+% years already. You shouldn't expect 20% next year. The bigger question is not what happens in 2025. It's what happens over the next 10, 20, 30 years. There are going to be many different presidents. And thankfully, I'll say it once again, thankfully, we live in a country where the economy is not dependent on this one individual.
Right.
It's likely going to be, I think, a split in power. So no matter who's president, it's going to be very difficult to get their agenda and you might passed. You might think that's good or bad, but what it tells me, Peter, is that they're not likely to have any significant power in terms of the economy or passing new legislation. There'll be other factors that drive the stock market, which is probably better for everyone. Okay, with that, let's end it right there. Thanks, everyone, for joining. If you're watching this on YouTube, take a moment, hit that subscribe button, leave a comment. I read all the comments, try to respond to as many as possible, and we'll see you next time on Signal or Noise.